Angel investing strategies for family offices. In previous videos, we discussed the benefits and drawbacks of direct investing, various options for increasing potential returns and managing risks associated with direct investing, and even covered most common mistakes investors make. In this video, we will bring these all together and discuss some common overall strategies for angel investing. First, let's look at some recent data from the Ewing Marion Kauffman Foundation and the Angel Capital Education Foundation. The findings from their research on angel groups points to some factors to consider as you determine potential strategies your family office can deploy to maximize returns. In particular, 4 factors seem to influence returns. Due diligence. The median time investors spent on due diligence is 20 hours per investment. Investors who spent more than 20 hours of due diligence on deals saw an average multiples of nearly 6 times their investments, while those who spent less than 20 hours averaged a 1.1 times return. Furthermore, those investors who spent more than 40 hours on due diligence per deal saw even higher returns of greater than 7 times. Interestingly, the mean time spent on due diligence was 60 hours, which implies that some investors spent well more than the mean of 20 hours. At some point, there is probably a diminishing return on time spent, which may border on analysis paralysis, but it is clear that there is a measurable benefit from investing at least 20 hours of time on due diligence before investing money into an early-stage company. Industry experience. Investments in companies where the angels had deep related industry experience saw double the average returns compared to companies in which the investors had low industry expertise. This may be a result of better due diligence because the investors were able to do a better job evaluating the new opportunities. Or it may be a result of the investors' ability to add value beyond just money. It stands to reason that investors with experience in the industry may be able to better provide mentoring and tap into their network of management talent, employees, customers, or even potential acquirers, thus increase the value and the valuation of their investments. This leads us to our next factor: active participation. Providing support above and beyond cash can nearly triple the return on the financial investment. Investors who met with the entrepreneurs at least once a month to provide mentoring, coaching, or connections, or even just to monitor the company's financial performance, saw an average of 3.7 times compared to only 1.3 times return for the investors who met with the companies only once or twice a year. Follow-on investing. At first glance, the data is scary. In ventures where angel investors made second or third investments in companies they've already invested, nearly 7% of the exits resulted in a loss of capital. Overall, companies that did not take follow-on investments saw an average of 3.6 times returns, compared to a barely positive 1.4 times return for companies with follow-on investments. This would indicate it is better not to invest in subsequent rounds of companies once you invest once. However, as we mentioned in a previous video about top mistakes investors make, there may be another conclusion to be drawn from this statistic. Most follow-on investments simply should not be made. Investors too often pour in good money after bad to try to save a company with a fatal flaw. The data does not discriminate between deals that were essentially doomed to fail and those deals where investors continue to fund winners. From these data points, it seems quite clear the best strategy to maximize returns on angel investments are to do at least 20 hours of due diligence per deal. Invest only in companies competing in industries you know well. Meet with the companies at least once a month. And don't do follow-on investments in companies not performing well. Let's just look a little deeper at these points to see what they really mean strategically. To do at least 20 hours of due diligence. Working full-time, one person could be able to seriously review at most 2 deals a week. If you invest in one company out of 25, this means that you can only make about 4 investments each year. Invest only in companies competing in industries that you know well. This is sometimes called vertical investing. Investing in one niche industry where you have more insight into the factors critical for a company's success. In addition, because you are focused, You constantly learn more and more about that niche, and thus can make better, more informed investment decisions. Something else to consider. Many angels and angel groups are entrepreneurs who made millions of dollars selling their company. They therefore generally have experience in industries with some growth or M&A activity, such as software, healthcare, and biotech. By contrast, there hasn't been a lot of recent windfall exits in the railroad industry, or watchmaking, or in the newspaper industry. If your family office represents primarily old wealth from industries that are no longer experiencing rapid growth and seeing a plethora of emerging companies, it may be a little difficult to invest in companies where you've had deep experience. We'll talk about this in a little bit. Another issue to consider is geography. Is there a critical mass of companies in your niche, in your region, or of the country of the world? If not, you may have to expect to travel quite a bit. Meet with companies at least once a month. This is one of the main reasons to invest locally, so that you can more easily visit with companies. It is also one of the reasons that there are more angel investors in entrepreneurial hotspots like Silicon Valley and Boston. Many investors have personal rules of thumb such as, I won't invest in any company more than 2 hours away. This does not necessarily mean taking a seat on the board of directors. You can still provide mentoring and strategic advice, or help with business development and fundraising. The big questions are, what do you have to offer? And how much time can you spend with each investment? These answers will largely determine your overall investment strategy. Don't follow on investments in companies not performing well. Investors can take this to one extreme and never invest a second time in any one company. This allows them to invest in more companies. Other investors have the discipline to view each new investment opportunity as a distinct decision, independent of their previous investment. In other words, if the due diligence on a follow-on investment shows that the company doesn't pass the muster, then they don't invest. This saves investment capital for the winners and thus focuses their investments on fewer, more promising companies. Another set of data may further refine your strategy. According to a combination of sources such as MergerStat, venture capital firms, and angel investors, are that companies don't need as much capital to build value as they used to. Most exits are under 20 million, and M&A exits are happening sooner in a company's life cycle. In other words, the data points to a strategy of making smaller investments and expecting faster, although potentially smaller returns. Receiving a 3 times return in 3 years means a 44% internal rate of return. Many investors would be happy with these returns, although this is far from the excitement of 100 times or 1,000 times return of angel lore and may require more focus than the strategy deployed by many very active angel investors, often called the spray and pray strategy. The spray and pray strategy is like buying raffle or lottery tickets. Investors using this strategy are looking for the one really big winner. The more tickets you buy, the better your chances. So they invest in a lot of startup companies. This approach often suggests 3 tactics. Generate high deal flow. Clearly, you need to have access to a lot of potentially big deals. This is easier for someone living or operating in Silicon Valley than, let's say, Wyoming. But with technology, online angel databases, and remote access to angel groups or networks, you can overcome geographic boundaries and have access to a lot of deals. Another strategy you can use is to partner with organizations, such as incubators or accelerators, that then help you start and help companies to grow. They can be sources of deal flow for you. Invest in anything that seems like it might be big. At, say, $25,000 per deal, to make 30 deals requires a minimum of $750,000. You therefore need to have relatively deep pockets. This does not include the potential for follow-on investments. It also usually requires somewhat of a passive approach unless this is all that you do. Don't worry much about terms, which can slow down the process and may be irrelevant if the exit is as big as you hope. Earlier, we mentioned the benefits of vertical investing and potential limitations for some family offices. Another strategy that can be used is called horizontal investing. In other words, find a specific business aspect that you know well and can be applied across a number of industries. An example from one of the most famous and successful investors is Warren Buffett's toll bridge strategy. Essentially, invest in companies in any industry with a business model that profits from lots of small transactions. Another example is the Walmart model. Invest in companies that create competitive advantages through excellent distribution systems. The first step in the strategy is to identify an element of business that you, your team, or your clients are very knowledgeable about and can find companies that use that element in their business, whatever their business is. It could be their business model, distribution systems, customer base, sales model, or any other aspect. Understanding your particular strengths may also suggest other strategies. Turnarounds. If your team is proficient at turning around troubled companies, then you can look for and invest in companies suffering a financial crisis. You probably would not be able to invest in a lot of companies at any given time, but you could expect clear increases in value as you implement better management or financial controls in the company. Follow-on. Some investors choose to simply follow the lead of other investors that they respect and trust. If you don't have adequate resources to conduct due diligence or provide targeted value, but you know other investors who do, you could develop relationships with these investors to invite you to join them on deals that they make. Doing so obviously puts you at the mercy of their decisions and whims, but when they are successful, you win as well. Regardless of which strategy you choose, over time, you may find that your successful investments share some things in common. It could be the size of the round, the industry, how much time you need to spend on the company, etc. It is important to look for these patterns because they don't always match your initial strategy. Or, they may help you fine-tune your approach within your strategy. You will then be able to focus on only those companies that match your firm's proven recipe for success and hopefully generate even higher returns.